Imagine having an extra $5,000 in your pocket just from claiming tax deductions. That could be you by the end of this video. Hi everyone, Kim here, back for another video to help you become a better property investor. Have you heard of the saying, a penny saved is a penny earned? Most people are missing out on a whole heap of savings, and the main reason is that they just don't have the knowledge or expertise. If you're anything like me, you're constantly looking for ways to save a bit more. So for today, I'll be sharing with you 20 property tax deductions you can claim on your investment properties, as well as what you can't claim. Before we get into it, we want to be clear that this video is for informational purposes. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent who can give you the best advice for your situation. Let's start things off with the biggest deduction: interest on your home loan. If you've got a loan on your investment property, listen up. You can claim the interest charge on that loan as a tax deduction. Depreciation. Depreciation is the term used for the wear and tear of your property and its assets over time. Luckily for you, it's a rental property deduction. Think of it as a non-cash investment property tax deduction. You can claim deductions on it over time and use it to offset against your income. After interests on loans, this is the second biggest tax deduction claim you can make. What's great about tax deductions is that you don't just claim it once. You can claim this for years as long as you don't sell or move into the property. If you've bought an investment property, contact a quantity surveyor like us at Tax to estimate how much you can claim. If your investment property commenced building after 16th September 1987, you could claim an investment property tax deduction on the building depreciation costs. The construction cost is also tax deductible as a rental property deduction if you decide to do any renovations on it. However, unlike the maintenance expenses, the construction costs aren't fully deductible in the same year that you pay for it. Instead, you can claim the costs in portions over several years. You can generally claim 2.5% of the construction costs every year from the time your property was built for up to 40 years. Plant and equipment deductions. Plant and equipment, also known as Division 40 assets, are also tax deductible. These are fixtures and fittings in your home, including carpets, lights, aircon units, and oven. Capital gains tax. If you decide to sell your property within 12 months of owning it, you'll need to pay capital gains tax on the profit of that sale. But if you own the house for more than 12 months before selling it, you're eligible for a 50% discount on your CGT. This means you'll only need to include half of the capital gain in your tax return. Quantity surveyor fees. Seeking advice from a quantity surveyor like us is the best way to maximize your investment returns. We can prepare a tax depreciation schedule for your investment properties. The bonus here is that the fees can also be claimed as a tax deduction. You can learn more about what quantity surveyors do by clicking on this video. Agent fees. If you prefer to leave your investments to the professionals, you can appoint a property manager to manage everything. They'll usually charge you anywhere between 6 to 8% of the rental income as part of their fees. Don't forget to claim these as a tax deduction. Insurance. Insurance, like landlord insurance, are no-brainers because you don't know what might happen to your property. Again, these are tax deductible expenses. Legal fees. You can claim legal expenses related to rental activities, like preparing a lease agreement or handling tenant disputes. However, solicitor or conveyancer fees for purchasing or selling the property aren't tax deductible. Advertising fees. When you're trying to find tenants, chances are you'll be using sites like realestate.com or Domain. The cost of advertising to find these tenants can be claimed as a tax deduction. Council rates. These expenses cover the cost of the garbage collection and maintenance of the street on which your property is located. As long as your tenant isn't paying the council rates, you can claim this as an investment property tax deduction. Utilities. Things like the electricity, water, and gas bills are claimable as a tax deduction. But be careful, if your tenant is paying for it, then it's not tax deductible. Repairs and maintenance. You can claim immediate deductions for repairs and maintenance to restore your property to its original condition, like fixing a leaky tap or patching a hole in a wall. Any improvements that enhance your property's value, like renovations or additions, must be claimed as capital improvements deductions over time. You can repair the property, but if you improve the property, you can't claim the repair and maintenance costs. For example, repairing or replacing the carpet in the property lets you claim deductions. But instead, if you were to install wooden floorboards to improve the property and consequently increase its value, you won't be able to claim it against repair and maintenance costs. Gardening costs. Just like repair and maintenance, as long as you're repairing or maintaining the garden or lawns for your home, then you can claim them as a tax deduction. Any improvements made, like a major landscaping project, can't be claimed. Cleaning fees. Whether it's ongoing cleaning or just cleaning expenses that occur whenever a tenant vacates your property, you can claim this as a tax deduction. Of course, if it's the tenant paying for the cleaning, you can't claim this as a tax deduction yourself. Pest control. Hiring a pest controller or the cost of doing pest control yourself can be claimed as an immediate investment property tax deduction. Land tax. As long as you've rented out the house on your property, you're entitled to claim the land tax as a tax deduction. Remember that each state has its own regulations concerning land tax, so always consult a tax advisor on how to ensure you're submitting the correct claim in the right year. Body corporate or strata fees. If your property is a unit or is a townhouse, you'll need to pay body corporate fees. This covers building insurance and the upkeep of shared areas. Provided that the tenant isn't paying for it, you can claim this as a tax deduction. Stationery, phone, and internet costs. If you've incurred any stationery, phone, and internet costs through managing your investment property, then you can claim it as a tax deduction. Bank fees. Any bank fees charged on the loan used to purchase your investment property are tax deductible. Now that we've talked about the 20 expenses you can claim, let's cover what you can't claim. First off, solicitor and conveyancing fees. Like I said earlier, you can't claim this regardless of whether you're buying or selling a property. Another expense you can't claim is stamp duty fees. It's a popular question we frequently get, but unfortunately, the answer is no. You also can't claim the travel expenses you've incurred for managing your property. Whether you're doing inspections or going interstate to view a property, you can't claim this as a tax deduction unless your business involves renting and managing rental properties. And finally, there's a matter of personal use expenses. This means if you plan to go to a vacation rental property and stay there for the weekend, any costs you've accumulated can't be claimed as a tax deduction. That's about it on the tax deductions you can and can't claim on your investment property. If you've got a lot of value out of this video, consider subscribing to our YouTube channel for more tax-saving tips. And make sure you click on the bell icon so that you can get notified of the next video. Thanks for watching, and I'll see you all in the next one.